I'm Brittany Lewis with Forbes Breaking News. Joining me now is Stephen Mathai-Davis, the founder and CEO of Q.ai. Q.ai is a next-gen AI-powered investing app that's backed by Forbes. Stephen, thank you so much for joining us.
Thanks for having me on, Brittany.
So for all of our Forbes followers who aren't as familiar with Q.ai, can you break down what your app does?
Sure. Q.ai is a next-gen robo-investing app. We're endeavoring to bring best-in-class investing and wealth management to modern investors through a one-tap investing model. Right now, Q.ai is only available on Android and iOS, but we're planning to expand to web app as well in a few months.
Okay, great. And so let's kick it off by talking about the stock market. So last week, stocks wrapped their first worst half of a year since 1970. The S&P 500 officially fell into a bear market in mid-June, but gas prices have dipped from their record highs, and according to AAA today, the national average of gas is $4.77 per gallon, but that is still well over $1.60 above the average at this time last year. So simply put, is the stock market going to crash in 2022?
Well, the question is, has it crashed as much as it's going to in 2022? And our bias is, yes, that's the case. And remember, we're not fundamental analysts. We're looking at our quantitative models, and we're using advanced AI to help predict where we think markets are going to go over the next week to month to quarters. And we're turning more bullish about where markets are today. That's not to say that the market is going to finish the year positive. We just are saying that incrementally from where we're at today, we don't see as much of a fall happening.
Great. And so what advice do you have for investors when trying to navigate this more volatile market that we find ourselves in?
Yeah, that's a great question. I think investing and trading is becoming increasingly more nimble and dynamic for those people who want to be successful in the markets. I'm not really sure buy and hold makes as much sense, especially with the repricing that's occurring across all sectors and asset classes. Now, what do I mean by more nimble and more dynamic? I think you've got to be more willing to cut losses, take profits much more quicker.
Okay, and so I remember last week you and I were having this conversation, and I asked you, what would you tell people that might be feeling a little anxious about investing? And the advice you gave that stuck out to me is you have to be contrarian. Can you kind of build off that?
Yeah, you got to be contrarian and kind of think out of the box. So, one of our favorite trades at the moment, we've been running it for a few weeks on Q.ai for our subscribers, has been a long gasoline and short oil trade. It's a pair trade. Now, this is something that's really common with hedge funds. And the reason we love the structure is because it performs well both in up markets and down markets. Because the goal really is not to necessarily see gasoline go up. The whole idea is to say that gasoline prices are going to structurally outperform oil prices, so that you're playing that spread. Now, this is a trade that would do well in an up market and a down market. Now, in a market where the S&P 500 is compounding 20 to 30%, do pair trades give you a similar return? No, they don't. On a risk-adjusted basis, maybe, but in aggregate, absolutely not. In a downward trending market, it's a great trade.
Okay, so I heard you mention pair trades. Can you elaborate on that, and why is that beneficial for the market that we're seeing now?
Sure. So like the structure of a pair trade, now what we do is something that's called dollar averaging, where we do dollar average pairs, where we're going long one instrument and we're shorting another instrument. And we're using actually inverse ETF, so we're always technically buying an instrument. And the whole idea is that you're playing a spread. Now, why do we like it in a downward trending market? Because gasoline and oil prices could fall. And in both cases, owning oil or owning gasoline is not a great trade. But what we're really doing is saying, well, the prices for gasoline are going to drop less than the prices for oil. So it's a great spread trade irrespective of what's going on in the market.
Sure, and to build off that, what's going on in the market right now, with the current shape of it, there are growing recession fears. So these fears are coming from inflation hitting a 40-year high, paired with inflation fighting interest rate hikes from the Fed. So S&P put the odds of a recession in 2023 at 40%, and this is more than the 35% odds Morgan Stanley forecasted at the end of June. So to this point, I want to talk about the updated report from the Bureau of Economic Analysts that was released last week. So the report shows that the economy last quarter posted its worst annualized showing since the pandemic-induced recession of 2020. So GDP declined by 1.6%, But the report also showed that GDI is up 1.8% in the first quarter. So first, can you elaborate on what this shows us? And second, in simple terms, do you think we're headed for a recession?
Okay, simple terms, just getting to the meat of the argument. No, we don't actually think a recession's coming. And just for our listeners, we were actually very bearish coming into 2022. And we're telling all of our users to really consider putting on what we call portfolio protection inside Q.ai, as well as considering going long precious metals and an inflationary protection kit. So we were out in November and December telling people, watch out for 2022. All that aside, before we get into what GDI and GDP is, for our listeners, the first thing I'd say is it's supposed to be the same thing. Just it's measuring, both are measuring economic output. It's just that GDP is measuring it from a top-down perspective, and GDI is measuring output from a bottom-up. Theoretically, they usually converge. When there's a difference, GDP tends to trend towards a GDI. So what's really interesting is that when people are talking about recession fears, this is all technical, as they're looking at quarter-over-quarter negative growth in GDP. GDI is actually pointing to a soft landing, right? Because it was up 1.8% annualized in 1Q. And just something else to think about. Final sales to domestic purchasers, which is a better measure of domestic aggregate demand, was up 1.6% annualized.
Okay.
That doesn't point towards a recession. Now, I'm not suggesting this means we're going to have boom, boom economic growth, but it would suggest that we're heading towards a softer landing. Now, look at retail sales. Retail sales are still positive period over period. They're not cratering. And nominal GDP growth, which is more of a measure of aggregate sales, and that's really what you should think about when you think about economic corporate profits, it was up, almost 7%, 6.6. So profits continue to be healthy. Look at the S&P 500 now. Does that mean it's time to go long stocks? I think you've got to be selective. The S&P 500 is now getting really close to its inline average, historical inline average over the last 5 to 10 years. It's trading around 16.4 times. That's a pretty healthy average for stocks. Remember, this is re-rated down from close to 19 times at the start of the year. So when I look at the market today, am I excited about shorting stocks? Not really. I'm more excited about going long selective areas.
Sure. And so in June, consumer confidence hit a 16-month low. So this has to do with people thinking that there's an impending recession.
Sure.
So you're saying you don't think there's a recession?
The evidence doesn't point to it, right?
Sure. So to build off your point, what other indicators can people who think that a recession's coming look to? What other data can they look to gauge whether we are headed to a recession? I know you mentioned retail sales. Is there anything else?
I mean, you would want to start looking at energy prices, right? Because that's going to be the real gauge. And we started off saying that energy prices are beginning to decline week over week. And that's been the major driver of inflation over the last year. And it's been inflation that's been eating into economic growth, and that's what has everyone worried about a recession. And you're beginning to see a decline. The way you have to think about inflation is that it's year-over-year comps. As we enter the fall, we're going to start comping those high levels we saw last year. It's going to be hard to say that year over year we're going to see acceleration in the back half of the year. The evidence, at least coming out of the oil markets, is that's not the case.
Sure, and to continue talking about inflation, economists at Goldman Sachs hiked their inflation projections over the weekend and joined other experts in forecasting that inflation will last longer than previously expected.
Sure.
So with that being said, what is an effective way to combat the impact of inflation on your portfolio?
Yeah, that's a great question. Usually we could talk about inflationary trades that would protect against a portfolio. What I would encourage folks to do is start thinking about downside protection and begin introducing hedging, more active hedging strategies. And this is what we talked about last week, right?
Sure.
It's no longer about necessarily generating 20, 30% returns. It's about trying to miss those 5 to 10% drops that you probably have experienced this year and compounding higher every month, every week. And when we think about hedging, what we're talking about more is just basic stock market hedging, maybe interest rate duration hedging. With Q.ai at the moment, we've introduced tech stock hedging. I would encourage people to start thinking more creatively in that fashion because we're exiting what was a historical bull market, right? This market's been rallying since 2010. I mean, realistically, we've been in a bull market since 2010. at some point the music ends. And that's kind of what's happening at the moment now, as markets are normalizing. And hedging strategies are just a great way to protect your portfolio from downside. It clips the upside, but it comes back to compounded interest, and that over time it's going to continue to grind higher.
I want to continue to talk about the conversation that we had last week.
Sure.
So, like you said, your biggest advice is to go contrarian.
Yep.
And would that advice on being contrarian change when it comes to different generations? So would you suggest to be more contrarian, maybe Gen Z or millennials, or have different advice as you get to a seasoned Gen X baby boomer investor?
Well, I think contrarian works no matter what age you have. I
Okay.
think how you express your contrarian view changes depending on if you're Gen Z or millennial, or whether or not you're a baby boomer or Gen X.
So according to the Conference Board, consumer confidence hit a new 16-month low in June. Like I said, so despite low consumer confidence, the economy is continuing to expand, with durable and non-defense capital goods orders rising month over month. So currently, economists and you seem to say that we're not headed to a recession, or if they are suggesting that, it's a mild one at best. But the confidence index suggests that consumers do feel otherwise. So can you explain this disconnect that's happening?
Yeah, that's a good question, right? It's the reason why there are a lot of macro investors like myself saying we're not heading towards a recession is that the data itself is not pointing towards it.
Sure.
But consumer confidence, at least declining consumer confidence, you can create this self-fulfilling prophecy that could push you towards it. And it's something that George Soros made famous in his concept of reflexivity, and then how its application to markets. Without getting too esoteric there, I would probably say in this case, just because of one survey being negative on one print doesn't necessarily mean it's going to head us towards a recession. I think it's something definitely to keep closer following on. But to me, in my opinion, the retail sales prints and how people are actually expressing their fears when they go shopping is a better macro indicator. And it's one that I would follow as a ex-consumer analyst.
So Stephen, thank you so much for joining us today and providing us with market insights, and I look forward to speaking with you again soon.
Thanks for having me on.